welcome to the deep dive. Today, we are looking at a financial mystery that, honestly, it completely breaks the fundamental laws of market physics.
It really does. It's one of the most baffling situations I've looked at recently.
Right. I mean, imagine a scenario where a company possesses an astonishing $25.4 billion with a B in legally contracted future revenue.
Which is just a massive pipeline.
It's unbelievable. And they're growing their current revenue at a blistering 84% year over year.
Yeah, by all traditional metrics, this is a business firing on every conceivable cylinder.
Exactly. And yet its stock has completely collapsed. I'm talking plummeting 31% in just 13 weeks.
It's a huge disconnect.
It is. So for you listening, our mission today is to unpack this glaring contradiction. We are using a comprehensive equity research report dated August 22, 2026.
Right, covering an AI infrastructure company called Cerebra Systems.
Trading under the ticker CBRS. And we are going to look purely at the factual data from this report, completely ignoring the market noise.
Yeah, you have to block out the noise to really understand how a business can seemingly secure the future of AI computing while the stock market treats it like a distressed asset.
It's a contradiction that is, frankly, keeping me up at night.
I don't blame you. The disparity between the fundamental business performance and the stock price action here, it's one of the most severe I have ever seen.
So severe.
You have a company that, on paper, is laying the physical groundwork for the next generation of artificial intelligence, yet the market sentiment is reacting with utter panic.
Okay, let's unpack this, because to solve this mystery, we first need to lay out the raw evidence of the disconnect between the company's financial momentum and its market reality.
Let's look at the numbers.
The numbers here are just wild. As of August 21st, 2026, the stock closed at $196.13.
Right.
That was down 6.5% just for that day alone, and it represents a massive 49% drop from its 52-week high of $386.34.
So the valuation has essentially been cut in half.
Exactly.
And, a 50% haircut usually signals a catastrophic failure in the core business.
Right, you'd expect something terrible.
Exactly. You would normally expect to see shrinking profit margins, massive customer churn, or just a complete collapse in top-line revenue.
But the fundamentals show the exact opposite. Let's look at the actual income. Revenue for the first half of 2026 was $373.5 million.
Wow.
Yeah, that is an 84% jump year over year from $202.8 million.
That's incredible growth.
And zooming in on their second quarter, core revenue specifically spiked 103% to $209.9 million.
And it's not slowing down, right?
Not at all. Management isn't backing down. They actually raised their full-year 2026 guidance to a range of $880 to $890 million.
Which is huge. And the forward projections in the research report go even further. They are guiding for a 3x growth multiple in 2027.
3 times.
Yeah.
Yeah.
If they execute on that trajectory, we are talking about revenue rocketing to around $2.6 billion in a single year.
Which brings us to the crown jewel of this report, the metric that makes this such a profound mystery.
The backlog.
Yes. Cerebras has a remaining performance obligation, often called an RPO, of $25.4 billion.
It's a staggering figure.
And they also have 600 megawatts of secure data center capacity. Now, for you listening, RPO isn't just a pipeline of maybe deals or, handshake agreements.
Right. It's not just a sales forecast.
Exactly. It is contracted, legally binding future revenue. It is money that customers have committed to spend. It just hasn't been fulfilled and recognized on the income statement yet.
Think of RPO as like locked-in economic energy.
I like that.
The contracts are signed, the capital is allocated by the clients. The only thing standing between that $25.4 billion and the revenue column is Cerebra's actually delivering the computing power.
So to put that in perspective, imagine a highly anticipated world-class new restaurant opens up.
Okay.
It is so spectacular that it's fully booked, every table, every night, for the next 10 years.
Oh, wow. 10 years.
Right. That reservation book represents that $25.4 billion RPO.
Makes sense?
Yet, for some bizarre reason, the original investors in this restaurant are standing out on the sidewalk, frantically selling their ownership shares to anyone walking by at a 50% discount.
Right.
Why are they running for the exits when the dining room is booked solid for a decade?
That restaurant analogy perfectly captures the absurdity of the current valuation. It really does.
It's baffling.
But to understand why investors are standing on the sidewalk selling at a discount, we have to examine the stock's beta, which the report pegs at an astronomically high 5.38.
A beta of 5.38. Let's break down the mechanics of that for the listener because the broader market standard is just a beta of 1, right?
Exactly. Beta measures a stock's volatility relative to the overall market.
Okay.
So a beta of 1 means the stock moves in perfect sync with the S&P 500. A beta of 5.38 means this asset is more than 5 times as volatile as the market average.
Wow, 5 times.
Yeah. If the market sneezes, Cerberus catches pneumonia.
That's a great way to put it.
When sentiment is bullish, a high beta acts like a rocket booster, amplifying the upside. But when uncertainty creeps, in which we will discuss shortly, that high beta ruthlessly amplifies the downside risk.
So it swings wildly in both directions.
Right. The market isn't just selling, it is reacting with hypervolatility to underlying risks that are really spooking institutional capital.
Before we get to those underlying risks,
Yeah.
we absolutely have to understand what Cerberus is actually selling.
The hardware.
Right.
Yeah.
What specific technological product is so compelling that corporations are willing to sign $25.4 billion in binding future commitments?
That brings us to their core hardware technology, the CS4 AI system.
Okay.
This is what the industry calls a wafer-scale engine. And crucially, Cerberus is aiming this system squarely at the inference market rather than the training market.
Let's pause there and explain the mechanism of this technology because wafer scale engine sounds like science fiction.
It really does.
Most computer chips, like the ones NVIDIA sells, are small squares. They are manufactured by taking a giant circular plate of silicon on the wafer and slicing it up into hundreds of tiny individual chips. To build an AI supercomputer, you then have to wire thousands of those tiny chips back together. But every time data has to travel off one chip, down a wire, and onto another chip, it creates a microscopic delay.
Right, latency.
Exactly. Cerberus looked at that process and did something radical. They just didn't cut the wafer.
They kept it whole.
Yeah. They used the entire massive dinner plate-sized piece of silicon as one single, gigantic, interconnected brain.
And by keeping all the computing cores on one contiguous piece of silicon, they eliminate the communication bottlenecks.
It's brilliant.
The data doesn't have to travel across copper wires or optical cables to talk to another chip. It just moves instantly across the silicon.
Wow.
That architectural difference is the foundation of their entire business model.
And they are applying that specific architecture to the inference market.
Yes. What's fascinating here is the economic distinction between training an AI model and running inference.
Okay, unpack that for us.
Because winning the inference market is structurally much more lucrative over the long term.
All right, let's use a tangible analogy to explain the difference. Training an artificial intelligence model is like writing a massive, incredibly complex encyclopedia from scratch.
It takes a lot of time and effort.
Exactly. It takes months of grueling labor, reading billions of documents, and it requires massive bursts of intense computing power to figure out how language works.
And that is the market NVIDIA has dominated.
Completely. But inference is what happens after the encyclopedia is printed.
Right.
Inference is simply looking up a word in that book. Every single time you ask a chatbot a question or self-driving car recognizes a pedestrian or a medical AI, scans an X-ray, that is inference.
Training happens exactly once per model version. It is a massive upfront capital expenditure.
Okay.
But inference happens millions or even billions of times a day, forever.
Forever, wow.
Cerberus is betting that while fortunes were made selling the heavy machinery to build the AI models, the recurring infinite revenue stream lies in being the absolute fastest at running them.
And the speed claims in this research report are staggering. Cerberus claims their new CS4 system delivers up to 30 times faster inference than NVIDIA GPUs.
30 times?
30 times.
Oh.
With a projected 20x throughput improvement mapped out by 2027.
That's insane.
30 times faster is not just an incremental upgrade. It is a completely different operational paradigm.
Yeah.
If you are a high-frequency trading firm or a real-time logistics network, a 30x reduction in latency changes your entire business model.
Because in the inference market, speed is the only metric that truly matters.
Right.
When an AI model is interacting with the physical world or processing live financial data, latency is the absolute enemy.
I hear that, but I have to push back hard on this point based on the equity research we are reviewing.
Okay, let's hear it.
The report explicitly highlights a massive caveat. These 30x performance claims are completely unverified by independent benchmarks.
That is a very fair point.
Right. We do not have any third-party lab validation in the data provided. So, as a financial detective, I have to ask, are these corporate buyers who signed up for $25.4 billion in contracts just taking a monumental leap of faith?
Are they just trusting the marketing?
Exactly. Are they looking at a glossy marketing brochure and handing over a blank check?
Well, vendor-supplied benchmarks in the semiconductor industry are notoriously optimistic. They are tested in perfect, controlled environments.
Sure.
So the skepticism regarding unverified claims is entirely warranted. However, when independent laboratory benchmarks are absent, institutional investors look for proxy validation.
Proxy validation.
Yeah, they look at who is willing to bet their own corporate reputation on the technology.
Following the smart money. If the tech works, the biggest players will adopt it.
Exactly. If we connect this to the bigger picture, the strategic partnerships Cerebras has secured provide that exact proxy validation.
Okay.
The research outlines 3 massive alliances. First, there is an integration with AWS Bedrock slated for the first quarter of 2027.
Now, for the listener, AWS Amazon Web Services is the undisputed heavyweight champion of enterprise cloud computing.
Right.
And Bedrock is their premier, fully managed service for building generative AI applications. You simply cannot secure a larger distribution channel on the planet.
And Amazon does not integrate unproven, faulty hardware into their flagship AI platform.
No way.
They rigorously test everything behind closed doors. That upcoming Bedrock integration gives Cerebras frictionless access to Amazon's massive enterprise customer base, allowing clients to rent Cerebras compute power by the minute.
This is huge.
Next, the report highlights an AMD Helios partnership expected in the fourth quarter of 2026, which focuses on disaggregated inference.
Let's translate that technical mechanism.
Right.
NVIDIA has maintained its monopoly largely through a software platform called CUDA.
The walled garden.
Exactly. It acts like a walled garden. You write your AI code for NVIDIA chips. It is incredibly difficult to run that code on anyone else's hardware.
Very difficult.
So disaggregated inference basically means breaking down those walls. It uncouples the hardware from the software so customers aren't locked into a single ecosystem.
By teaming up, AMD and Cerebras are attempting to construct a unified hardware and software alternative that directly challenges NVIDIA's walled garden.
Wow.
They are offering the market an escape hatch from vendor lock-in. Furthermore, the report details an expansion into Europe via the Colosseum partnership, which includes deploying 200 megawatts of data center capacity on the continent.
That taps directly into the growing demand for sovereign AI, right?
Exactly.
Governments and European corporations are becoming increasingly anxious about sending their proprietary data to American servers. They want their AI processed on European soil under European privacy laws.
And your earlier skepticism about the leap of faith becomes highly relevant again when we look at their customer base.
How so?
While these partnerships are impressive, the equity research explicitly cites OpenAI as a major dependency for Cerebras. There is significant customer concentration risk.
Oh. Having the creator of ChatGPT as a whale client is the ultimate double-edged sword.
It really is.
On one hand, it is the most prestigious stamp of approval in the AI industry. On the other hand, if a single whale client accounts for a massive chunk of that $25.4 billion backlog, they hold all the leverage.
All of it.
If OpenAI pivots to a different architecture or uses their immense volume to demand brutal price cuts, Cerebras's profit margins could evaporate overnight.
A concentrated revenue base is inherently fragile, no matter how large the aggregate dollar amount appears on the balance sheet.
So we have mapped out the explosive 84% revenue growth. We've explained the mechanistic advantage of the wafer-scale CS4 product.
Right.
We've examined the elite hyperscaler partnerships. Now we finally have to address the dark cloud hanging over this stock.
The cash burn.
Yes. We have to answer why a company with all these tailwinds has a beta over 5 and has lost nearly half its market value. The answer lies in the brutal reality of their cash burn.
Building unprecedented silicon architectures and outfitting 600 megawatts of physical data centers requires a staggering amount of capital.
I can imagine.
In the first half of 2026, Cerebras posted a net loss of $464.5 million.
Wait, nearly $500 million evaporated in just 6 months.
Let's break that down quarter by quarter because the trajectory is what is spooking the market.
Okay.
The net loss for the first quarter of 2026 was a relatively modest $14 million.
Wait, if Q1 was only $14 million, but the total for the first half was $464.5 million, That means the second quarter alone suffered a $450.5 million loss.
Exactly. The market was suddenly hit with a quarter-over-quarter loss expansion that is almost difficult to comprehend.
Massive.
Simultaneously, their capital expenditure, the actual cash spent on physical assets, nearly tripled to $548.8 million. When the analysts calculate the free cash flow proxy for the first half of the year, it sits at a deeply negative $596.3 million.
Here's where it gets really interesting, though. If you just read those cash burn numbers, you would assume this company is weeks away from filing for bankruptcy.
You really would.
But as a financial detective, when you flip to the balance sheet in this report, it tells a totally contradictory story.
Let's hear it.
Their total cash on hand sits at an immense $6.742 billion.
Wow.
Furthermore, their stockholders' equity flipped from a negative $194.6 million at the end of 2025 to over $9.1 billion by mid-2026.
That is an astronomical infusion of capital in a very short window.
And the sources also note there are fewer than 200 days of trading history on the technical charts.
Right.
You don't just stumble upon nearly $7 billion in cash and $9 billion in equity while burning $500 million a quarter.
No, you don't.
The underlying mechanism here strongly implies that Cerebras executed a massive initial public offering or a gargantuan private equity raise right before they listed on the public markets.
That makes perfect sense.
They didn't just go public. They armed themselves with a generational war chest.
And that capitalized war chest completely changes the context of the cash burn.
How so?
The market is staring at a $450 million quarterly loss and reacting with high beta panic. But the balance sheet proved the business is fully capitalized to absorb this aggressive infrastructure expansion.
Okay, that's reassuring.
Additionally, there is a vital piece of data buried in the cash flow statements that provides a major silver lining.
What's that?
Despite the tripling of capital expenditure, their operating cash flow actually improved by 62% year over year.
Let's explain the mechanics of that for the listener, because it sounds contradictory. How can the net loss explode to $450 million while operating cash flow improves?
It comes down to the difference between capital expenditure, or CapEx, and operating expenses, or OpEx.
Right.
CapEx is the money spent on buying physical long-term assets, the concrete, the cooling towers, the actual servers required to build out that 600-megawatt capacity.
The heavy infrastructure.
Exactly. That massive spending hits the free cash flow and the net loss heavily. Operating cash flow, however, isolates the day-to-day economics of running the core business, paying employees, standard overhead, and the margin on the compute they are currently selling.
So the core business of selling inference compute is actually bleeding less cash.
Precisely.
Operating cash flow improved from negative $123.8 million to negative $47.4 million. They're getting closer to breaking even on their day-to-day operations.
The underlying business model is demonstrating leverage. As their top-line revenue scales up by 84%, those fixed daily operating costs are getting absorbed much more efficiently.
Okay, that makes sense.
They're simply choosing to spend a fortune right now on physical infrastructure to ensure they can actually fulfill the $25.4 billion backlog.
So what does this all mean? We have laid out an incredible bullish thesis. A mathematically validated pipeline of future revenue, top-tier enterprise partners, and a cash pile big enough to survive the infrastructure build-out.
Yes.
Conversely, we have a terrifying bearish thesis. An unproven, standalone profitability model, massive customer concentration risk with OpenAI, and a jarringly high quarterly net loss.
It's a real tug-of-war.
For you listening, if you are analyzing this battleground stock, what are the exact catalysts you should prioritize over the next 6 to 12 months to see which narrative wins?
The equity research maps out two distinct pathways. We need to look at the blue sky scenario and the thesis breakers.
Let's start with the blue sky scenario. What does the optimistic path look like mechanically?
In the blue sky scenario, that $25.4 billion RPO begins converting into recognized top-line revenue exactly according to management's guidance.
Good.
The AWS Bedrock integration in early 2027 launches smoothly, providing immense distribution.
Right.
The AMD Helios partnership successfully proves that disaggregated inference works at scale. And most critically, the unverified 30x speed advantage is finally validated by independent, real-world production environments, confirming the architectural superiority of the wafer-scale engine.
Wow. If all those mechanisms lock into place, revenue eclipses $2.6 billion next year, the operating cash flow flips to positive, And the path to GAAP profitability, meaning standard fully compliant accounting profit, opens up by 2028 or 2029.
Exactly.
At that point, the stock likely re-rates dramatically because it sheds the identity of a speculative, cash-burning AI bet and becomes a highly profitable inference utility.
But we must weigh that perfect execution against the thesis breakers, the specific risks that could unravel the entire valuation.
Mechanically, what is the fastest way this thesis breaks?
The most immediate threat is the cash burn accelerating rather than moderating. If the operating cash flow stops improving and the capital expenditure continues to spiral, even a $6.7 billion war chest will begin to look finite.
That's a scary thought.
The second major risk is the OpenAI dependency. If OpenAI decides to diversify its hardware providers to reduce its own reliance on Cerebras, or uses its leverage to negotiate aggressive price cuts, the margins on that $25.4 billion backlog will compress significantly.
There is also the ever-present apex predator in the room, NVIDIA.
Always.
If NVIDIA manages to release a new architecture that closes the latency gap and erodes that 30x speed advantage, Cerebrus's entire competitive moat simply evaporates.
It's a huge risk. The collision of these blue sky potentials and thesis breaker risks brings us to the ultimate near-term catalyst. The singular event that will force this high beta stock to pick a definitive direction: the Q3 2026 earnings report.
Why is the third quarter earnings report the absolute linchpin?
Because institutional patience for the trust us the revenue is coming narrative has clearly run out.
Right.
Q3 will be the first full quarter that reflects the newly raised guidance trajectory and the initial market absorption of the CS4 system. The market is going to demand concrete, audited proof that the RPO is actively converting into recognized revenue at an accelerating rate.
That makes total sense.
This raises an important question regarding the current market psychology. With the stock down 31% in just 13 weeks, has the broader market already heavily priced in the execution risk and the shock of the Q2 cash burn, while completely ignoring the massive upside optionality of the 2027 AWS integration?
That is the ultimate $25 billion question. A beta of 5.38 dictates that the market is coiled like a spring.
Exactly.
If Cerebras misses on their Q3 revenue targets, or if the pace of RPO conversion slows down even slightly, the punishment will be swift and severe, especially since the stock is already trading in a highly vulnerable technical setup.
Conversely, if they beat expectations and clearly demonstrate that the massive Q2 loss was a one-time pain associated with scaling infrastructure, the sentiment could snap back to the upside with equal violence.
Right.
If hyperscalers like AWS are actively deploying Cerebras hardware at scale, the dominant narrative instantly shifts from cash burn risk to infrastructure dominance.
It is a high-stakes battleground in every sense of the word. To summarize what we have unpacked in this deep dive, Cerebras Systems pairs an extraordinary $25.4 billion contracted revenue pipeline, 600 megawatts of secured physical capacity, and elite hyperscaler partnerships with brutal capital intensity and completely unproven standalone profitability.
It is a violent tug-of-war between a breathtaking technological future and a deeply expensive present.
The market is sitting with its finger on the trigger, waiting to see exactly how fast that technological future can be transformed into bottom-line reality.
It's going to be a wild ride.
Which brings us right back to the paradox we started with. The world-class restaurant booked solid for 10 years, with its initial investors frantically selling their shares on the sidewalk.
It's a great image.
It leaves you, the listener, with a final provocative thought to ponder on your own. If a company armed with a contracted backlog of $25 billion and nearly $7 billion in cash can still lose half its market value from its peak, what does that say about the broader market's current state of impatience?
A very good question.
Has the tech sector's decade-long era of rewarding growth at all costs officially died, replacing it with a ruthless, unforgiving demand for immediate profitability today? Thank you for joining us on this deep dive. Keep questioning the underlying mechanics behind the financial headlines, and remember, in markets governed by a beta of 5, absolute precision is a myth. We'll see you next time.